Good morning and welcome along to the month of February's edition of Portal Asset Management's review of the market. So of course I'm here today with Mark Witten, our CIO, and Mark is this time in Cape Town attending a Hedge Week conference. Over to you, Mark. What's been happening and what's the view of the world from Cape Town?
Yeah, so this is an annual hedge fund symposium, the Hedge News Africa conference. It brings together around 250 investors and fund managers, mostly focused on the sub-Saharan market. You know, the overall macro view was quite pessimistic. It started off, we had some macroeconomists and one of the speakers was out of BlackRock talking about, the impact of tariffs, the expectation of a recession, the tariffs causing a recession, geopolitical uncertainty and so forth. It was balanced by some of the views of the fund managers participating in the panels in that, oil has dropped from, over $80 down to 68. There's a lot more focus on unwinding or reducing the level of conflict between, in the Ukraine, which I think would be seen as positive. So there was both pessimism as well as optimism. People seem to be, looking at the markets and saying, well, the markets really had a strong rally throughout 2024 and into the beginning of this year and are now selling off globally. Bitcoin had its sell-off in February. It had a very difficult month, dropping close to, at one stage it was down about 25% before rebounding from 78,000 to close around the 84 level. And subsequently has held that position and recovered up. So even though the rest of the global indices are coming off, I think Bitcoin, as usual, is an early indicator and has pushed back up. I think the final kind of feedback or the final takeaway from me from the conference is that there's a lot of demand, there's a lot of interest and pent-up demand for crypto and for alternative solutions. Obviously, South Africa is a small ecosystem and it's, sub-Saharan Africa in general is not as liquid in terms of deploying large amounts of money. So fixed income is a bigger focus in real estate. And there's a lot of interest in that. There's only 2 or 3 other, locally domiciled hedge funds, and there's a lot of interest in both our funds in terms of, how we monetize our views on the market.
What we've seen in February, of course, is an enormous amount of volatility, and it's the volatility that people don't generally like, which is downward volatility. And of course, with the Bitcoin maximalists, and I've heard a lot of them speak over the last week or so, and I've attended different organizations, investment committee groups, etc., and they, of course, have been seeing this as a buying opportunity for Bitcoin. So they've been dollar cost averaging at fairly large amounts of money into that space. The volume was still fairly high when Bitcoin's price dropped along the way. So we're still seeing large organizations deploy to it. Of course, we also saw just recently that Texas is running their application in to create a strategic Bitcoin reserve for Texas, not for US, for Texas. And that strategic Bitcoin reserve, if you connect it to country size, Texas is the 17th largest economy in the world. And they're looking at deploying a Bitcoin strategic reserve. As we speak, and we're recording this on Friday the 7th, the President of the United States has made an announcement about establishing a Bitcoin strategic reserve and a crypto, how did he call it? It was a crypto sort of store or collective area. And whatever they seize with crypto along the way, they'll store in there. So 2 separate things. I think that's a good thing because Bitcoin really is separate to each one of those. Some clear confidence there, yet at the same time, the market is a risk-off market. That's why we're seeing a good part of this volatility maybe, Mark, because there's quite different schools of activity occurring. Fundamentals looking good, and at the same time, concern about the economy impacting. Is that how you see it too?
I think the main driver of the correction in February in the crypto space was the unwind of the carry trade that I think not so much crypto-focused hedge funds, but more global multi-strat funds had been riding. They had been buying Bitcoin and selling the futures and waiting for that to narrow, and we're getting around a 10%, 12% yield, and that turned negative as they unwound that as a delta neutral trade. I think the knee-jerk reactions to the tariffs were initially understated, but there has been a reaction to that as the deadlines have moved closer. I think we are seeing potentially a slowing global economy, and I think oil is also telling us that, as it sees inflation kind of dissipate. So I think it's a balanced view in that I do believe inflation is going to be, it's dropping much faster than expected, and therefore rates and global liquidity should pick up. I think that's the biggest driver we've seen traditionally of Bitcoin and crypto prices in general, but Bitcoin in particular is the level of global liquidity, particularly M2 in terms of money supply. And I don't think that's going to, I was expecting it to peak towards the end of this year, but I don't think so. I think it's actually going to continue to rise and probably only peak in the middle of next year. So I do think those are kind of the current drivers. There's also a bit of sentiment in that if you look at the market, looking at it just for February, it tells you one story. But if you go back and look at it over 6 months, you must remember whether it's Bitcoin or the markets themselves, over the past 6 months leading into February, the Bitcoin was up, close to went from 60 odd thousand to over 100,000. So Bitcoin was up like, 50, 60%. And there was obviously some profit taking and, a bit of unsustainability. And once it was breaking new all-time highs, it got to 110,000 in December, and then got back to 108,000 in January, and just didn't seem to be able to hold those levels. So there could be just a little bit of profit taking as well. We have seen a big increase in the, what they call the ratio of put to call ratio. So the bearish indicators in the market. There's a lot more purchasing of puts, particularly on the big, what they call the Magnificent Seven, the big tech stocks in the US. That spiked. So there's a lot of concern around the downside there. That could be related to AI and so forth. My biggest concern at the moment, what I'm watching is you're seeing this big split between the US and its traditional allies in Europe in the form of NATO. And that's, leaving kind of Europe in a bit of a vulnerable position, sandwiched between an ally that potentially doesn't really have their back anymore, and then you have this kind of aggression that continues to push out of the east. Europe announced a $900 billion, the ECB $1 billion loan facility for Europe to rearm themselves, to spend on defense. And that'll be very positive for certain industries and unemployment, I suppose, in certain countries that are facing that. At the same time, it increases the risk, the geopolitical risk, the outlook for potential conflict further down the line. So it's, I think we're going to be in a heightened volatility situation, regardless of what your views on whether, what the outcome is going to be. It's going to be a heightened volatility situation for the next, I'd say, at least 3 to 6 months until you get to the midterms. Then I think things might start to settle a little bit as people start reviewing. We're definitely going to be testing the upper boundaries again, 110, 112, maybe even 115,000 in Bitcoin. But I also believe you're going to get a chance to buy it, closer to 80, maybe even 75 over the next 2 to 3 months, which is great for both the strategy we're running actively with Radiance as well as the Portal Digital Fund and how we've reorientated that portfolio.
Yeah. Very interesting. Look, you've talked about volatility, and we've regularly said this, and it's true. And that is, in this particular space, this asset class, Bitcoin is not a bug. In fact, Bitcoin is a feature. The volatility of Bitcoin is not a bug, but rather Bitcoin's volatility is a feature. In other words, rather than run from it, you just got to A, acknowledge it's there, or B, generate a return from it. And so for those that are just simply buying and holding, that often means dollar cost averaging and entering Bitcoin at a price which is buying the dips over a period of time and rebuying the dips, because essentially you're going to see them occur. And in our case, where we generate income paid in Bitcoin using volatility, there's plenty of volatility there, so therefore there's plenty of premiums for us to be able to generate a return. In which case, stop worrying about whether Bitcoin is going to be up 20% tomorrow or down 20%. It's just what happens with Bitcoin, isn't it, Mark? It is just highly sensitive to external sentiment and to correlations with money flow and liquidity.
Yeah, I think investors don't mind volatility as long as they can then size their positions. We went through the research we've done that we relied on. A lot of it was pulled out of Bloomberg's, their reporting, in that if you had allocated 1% to Bitcoin in a balanced 60-40 fund instead of 100%, the 1% allocation would have given you 2% outperformance per annum over the decade. I mean, Bitcoin is still the top performing asset class in almost every metric in terms of 1, 3, 5, 7, 10 years. Over the past 5 years, as you stated, the compound average annual growth rate has been 68%. The participants at this conference they're not concerned around the volatility. They're kind of more wondering what the upside potential is, because it's not where the ball is today, where the market is now. It's, what are you thinking forward? All the available information is imputed almost instantly into the markets currently. So, if you're concerned around, whether we spoke about the tariffs, inflation, etc., the markets are telling you that there's potentially a recession coming in 6 to 12 months. On the price prediction side, we would say, as much as past performance is no predictor of future performance, you could, use as a baseline a compounded average annual growth rate of, call it 35%. And then, over the next 5 years, call it almost 6 years to the end of 2030, the various predictions in terms of a bear case of $300,000 and a bull case goes high as, 1.5 million in terms of ARC and Fidelity. So I think, somewhere in between there, even if it's like $500,000, $600,000, is definitely on the cards. It's not, if you look at where Bitcoin was 10 years ago to where it is today, but not just where Bitcoin is, also the ecosystem. A lot of what we spoke about was the fact that the markets 3, 4, 5, 7 years ago were technically uninvestable to institutional investors. There was no custody solutions, counterparty risk, not a lot of reg. And there was also actually, pushback from the reg side. And that's unwound and is moving in the right direction. I have support on the reg side, as you saw with Trump's strategic Bitcoin reserve today.
Yes.
But you also have much more institutional players in the space. And that means that if anything, not only the interest is going to grow, but the solutions and the applications, whether it's in credit, lending, etc., are going to continue to grow and bring more and more interest into the space. Bitcoin is different to all the alts, as we know, and seen more as a store of value in digital gold, as well as it will be going forward a reserve for both corporate as well as sovereign balance sheets. So I think you're right in that watching the price and staring at the screen and wondering if it's going to trade up to 90 and then it's going to trade down. I'm not really all that worried about that in the short term. I think we need to focus on where it's going, the trend, because getting the trend right is the most important thing. And the trend, I believe, is very much, as I always say, up and to the right. And then focus on actually delivering the yield, the underlying yield of the strategy that we've been implementing, because that's really where the alpha comes from, is generating that 5 to 7% per month in additional Bitcoin as an actual yield on the strategy.
Yes, that's right. So one of the things, certainly for those that are simply getting excited about their Bitcoin or possibly wanting to acquire more, and maybe they're on an exchange which gives them the opportunity to leverage, never investment advice. But in something that is so volatile like this, if you are truly leveraging to hope that you're going to get, price improvement without any protection, this is an asset that is particularly dangerous for, because it's so volatile. Yet, when you look at what Kathy Woods and others, Michael Saylor from Strategy, etc., are predicting between now and 2030, and the rationale of why, and that is that Bitcoin has a fixed amount of coins, that are available, and the demand side is increasing in steps, such as institutions coming on board, ETFs coming on board, already there, sovereign wealth funds coming on board, states coming on board, like Texas I just mentioned. Each one of those is like a step in price. Because the supply is fixed. So as they come on board, it steps up. I think there's some really valid arguments with data to support it, to suggest that somewhere between 300 US and 1.5 million US, and we've chosen the middle at about 710 US, is where Bitcoin is likely to be by 2030. Well, that's not a bad return. It's sitting in the 80s today. So that's a hell of a return. But the journey there is one with volatility. And that's what we've all got to know. Either generate benefit out of that by buying the dips, or in our case, building yield during that period of time. What's the knowledge base like in Cape Town? And in fact, you had institutional investors in the room when you were speaking. What's their knowledge base like for Bitcoin, firstly, and crypto, secondly? And are they warming to the asset class now?
So I think on the hedge fund side, most of the hedge fund operators are pretty astute and are actually running internal strategies. I think in their PA sort of trading accounts, they are running current crypto strategies, as they generally do for a year to 3 years before they roll it out, if the track record is warranted. Traditionally, there's a lot of interest, but there's also concerns around the reputational risks of allocating to a relatively unknown asset class. Not reputational from the perspective of there's anything wrong with crypto, but reputational in that they, you're concerned around the returns, what the potential, as you say, the downside vol could be. There was a really good, both our funds received a really good reception. The institutional investors were very happy or very impressed with Portal's, 25% compounded per annum return with much lower vol and diversification benefits and institutional setup between the Cayman and Singapore domiciled investment manager. So there was a lot of institutional interest there. I think on the private wealth side, they were interested in, they hold Bitcoin. A lot of the investors are long Bitcoin, not substantially, but 1% of the portfolio at best, or they just have a Bitcoin or two. And there was interest in the yield that we expect to generate, the strategy that we're running. The explanation of, it is a geared strategy, so you are going to see, beta 1 on the downside, with your losses potentially capped around 30% down, as we have protection there to ensure liquidation risk is minimized, and then your potential on the upside is 1.5 to 2 times beta. So the guys are interested in that, but there's obviously a reticence to hand over the Bitcoin. So they're kind of like, I'm just happy to hold it longer term. It's kind of like gold. I don't expect much of a yield from it. The knowledge on the alts is not really there. I don't think many people have delved into the space. I think it's also because you're less able to trade it here, due to Reserve Bank requirements and restrictions on capital, outflows. There aren't many crypto exchanges, and there isn't a huge amount of retail money that's gone into the space. So there's appetite, and there's definitely a lack of skill, which is, from our perspective, it's a really good gap to try and fill. On the flip side, there's the, call it the traditional way of making money, and what investors are comfortable with, and what investors in South Africa expect on the local portfolio versus the offshore. And most investors on the offshore allocations are looking at capital preservation. So they're looking at low risk, cash plus 3% sort of strategies. So it's been really educational, as well as I'm quite inspired. I think there's a perception that things were not going so well in South Africa, and there's concerns around. Trump has also been, pushing South Africa out of the trade agreements that they had, and the USAID payments and so on. And there's a lot of concern around the expropriation bill that was passed. But if you look at the perception is there. But you look at the underlying activity, both Johannesburg and Cape Town are very, very busy. Lots happening, lots of property development, lots of inflows, lots of foreigners actually moving here. It's quite weird. South Africans may be leaving, but Europeans are moving here. I think they see. South Africa is a little bit of Switzerland.
Mostly Russians and Ukrainians, because I see that in Thailand. That in Thailand, it's just every second person seems to be speaking Russian.
No Russians. Haven't met one, not one here. Lots of Germans, quite a few Brits, a lot of British and French, and the property prices here in Cape Town have been, kind of exponential.
Lifting.
There's a lot of UK-based and European companies have relocated teams here, which is quite interesting to me. There's a lot of recruitment drives here in terms of setting up teams, because getting paid in euros or pounds and living here is a lot more palatable than the cost of living increases in Europe. So I think South Africa is doing actually pretty well, excluding the politics, which is always a bit of a disaster. The budget here was thrown out, which is good. They realised there's a massive hole there that they can't. They can't fill by increasing VAT. There was a big topical discussion here. It's kind of no more taxing of the people. The people have sort of had enough of that, which I think we're seeing. You're seeing that pretty much globally as infrastructure is strained. The last thing I'd say on the appetite here is that there's a lot of very astute investors based here that understand markets, understand global markets, understand how to invest. We're in this sort of middle of the world in terms of the time zone. So there's a lot of global traders and global investors here. There's ways around how you can set up funds offshore. And, a lot of the questions I fielded and a lot of the conversations I had with peers as well as investors was around, what's a better domicile? Is it BVI versus Cayman? So you can see that I do believe there's a wave of investment in the space coming out of South Africa, and a wave of new product as well. Many of the funds that were, call it $1 billion 5-7 years ago when I left are now $5 to $8 billion funds. So there's a lack of skill here. There's a lot of concentration risk in that the bigger funds are getting bigger. And it's not like, the US or Europe where there's a lot of new funds coming through. That hasn't happened yet. There's a small amount of new funds and a lot of bigger funds. So there's an appetite for new product. There's an appetite for new skill as well within the space. And there's definitely an appetite for crypto.
Intriguing. And of course, it's Cape Town, which is absolutely beautiful, I'm advised. It's our neighbour. So when we say I'm based in Perth, same time zone as Singapore, regularly in Singapore, but based out of Perth. And it's, when you look across the Indian Ocean, it's the next stop is South Africa. And so beautiful place, I've heard, so not a bad place to live and work by the sounds of it too. Mark, thanks very much indeed. We, of course, will meet again on this topic, the topic of crypto and global macro and the Portal Asset Management's advisory funds that we advise next month to give the March update, which already this first week has got a lot of interesting occurrences that we can share at that time. Thanks very much for the time. Look forward to seeing you very soon.
Thanks, Derek. Chat soon. Ciao.